Welcome to the Deep Dive.
Hello?
Today, we're putting on our TalkTickers hats.
Yep, time for an earnings call breakdown.
Exactly. We're diving into the latest from Auna. You shared the materials, Q1 2025.
That's the one. A healthcare platform in Spanish-speaking Latin America.
And our mission today is really to cut through the numbers, the management commentary, figure out what's actually happening.
Especially since those headline results, well, they came in a bit lower than people were expecting.
Right. So let's start there. Consolidated results, lower than expected. What were the key numbers?
Okay, so if you look at it on an FX neutral basis, strip out currency moves.
Yeah.
Consolidated revenue for Q1 was up just 4%.
Okay, only 4%.
And EBITDA, earnings before interest, taxes, depreciation, and amortization, that was up only 1%.
So, yeah, definitely slower growth than maybe anticipated.
A bit of a miss, you could say, compared to what the street might have been looking for.
Okay. But was there any positive news in there? It wasn't all gloomy, was it?
No, definitely not. Actually, for the fifth quarter in a row, they managed to post positive net income.
Ah, okay. That's a decent streak.
It is. And looking at the balance sheet, their debt leverage, it stayed stable compared to the end of last year, unchanged from Q4.
Right. But I did see the cash position dipped a bit.
It did, yeah. Down about 15% during the quarter. But management still characterized it as solid.
Okay. So the big picture.
Yeah.
Growth slowed down, profitability streak continues, balance sheet holding steady.
That's a fair summary. But, to really get why that growth slowed.
You got to look at the different countries.
Exactly. You have to peel back the layers and look geographically. That's where the story really unfolds.
Okay, let's do that. Where shall we start? Peru seemed like the bright spot.
Absolutely. Peru was really strong. It outperformed significantly and basically drove all the consolidated growth they did get.
Okay.
Revenue in Peru jumped 10%.
Nice.
And adjusted EBITDA was even better, up 19%.
Wow, 19%. So that suggests operating leverage, right? Revenue growing faster than costs.
Precisely. It shows they're getting more efficient as they scale up there, increasing efficiency.
And were there other signs of that efficiency?
Yeah, capacity utilization was increased by 4.4 percentage points.
Okay.
And in their health plans business in Peru, membership grew a solid 10% year over year.
Good growth there too.
And maybe most importantly, the MLR, the medical loss ratio for their oncology segment.
Which is a key focus for them.
Right. That MLR decreased to a very healthy 51.6%. Lower is better there, means they keep more of the premium.
So Peru looks like the proof of concept. The vertically integrated model working well when it's mature and scaled.
Exactly. It really shows the potential for, medium to long-term earnings power when all the pieces click into place.
Okay, so Peru's the good news story. Then Mexico.
Yeah.
Sounds like that's where they hit some bumps.
Yeah, Mexico definitely ran into some issues. Operational setbacks, market softness. The growth momentum they had actually reversed.
Diverse. How bad?
Revenue decreased 4% on an FX neutral basis.
Ouch.
And adjusted EBITDA was down 5%, again, FX neutral.
And what was the root cause? Was it tied to rolling out their specific model, the Auna Way?
That seems to be the main thing. Management pointed to a key challenge around changing relationships with legacy suppliers.
Okay.
When they brought in tighter controls and approval processes for medical supplies, part of their efficiency push, they apparently underestimated the economic hit this would have on the doctors.
Wait, hang on. How does changing supplier rules affect doctor productivity? Were the doctors getting something from the old suppliers?
That's the implication, isn't it? It seems like many physicians had, let's say, established relationships or arrangements with those older suppliers. And Auna's changes disrupted that ecosystem. The stricter controls meant doctors had to change how they source things, maybe workflows too, and that initially slowed them down. Productivity fell.
Right. Shows how embedded those economic ties can be.
Exactly. And the friction you get when you try to bring in a disruptive, potentially more efficient model.
So a classic implementation hurdle. The theory meets the messy reality of ingrained practices. What are they doing about it?
Well, management says they reacted quickly. They've put in corrective measures.
Like what?
Including taking a more progressive approach.
Yeah.
Helping physicians transition over time instead of just flipping a switch.
Okay. Phasing it in more gradually.
Seems like it. And they did say on the call that volumes are already starting to recover because of these adjustments.
And they called this physician issue a threshold event. What does that mean?
Yeah, they framed it that way, like it's a specific hurdle they need to clear.
Okay.
Once they get past this friction point, they believe they can unlock the full efficiencies of the Auna Way in Mexico. They see it as temporary, transitional.
Not a fundamental problem with the model itself, just a rollout challenge.
That's their position.
Did the wider economy in Mexico play any part?
It did, yeah. They mentioned the macro environment, general uncertainty, also dampened demand a bit. People may be putting off elective procedures, that sort of thing.
Makes sense.
But it's worth noting, even with the volume issues, Mexico still maintained a pretty healthy adjusted EBITDA margin, 33.2%.
Okay, so not a total disaster on the margin front, despite the top line dip.
Right.
Okay, let's hop over to Colombia. What was the main story there in Q1?
Colombia was all about managing risk, specifically payment risk, getting paid reliably.
The collections issues they've talked about before.
Exactly, and improving the cash cycle. So they've been pushing these risk-sharing models with payers.
How's that going?
It's gaining traction, apparently. Right now, it's about 20% of their revenue in Colombia, and they're aiming for 30% by the end of this year.
And is it helping with the cash flow problem?
Seems so.
Yep.
They're also diversifying their payer mix, moving away from payers the regulator had intervened with. That's resulted in better payment flows overall.
Right.
And crucially, they reached a payment plan with a big one, Nova EPS, back in March.
Okay.
And management confirmed on the call that Nova started making timely payments in Q2, which significantly helps the cash flow outlook for Colombia.
Good news there. How did revenue look in Colombia?
Modest increase, up 5% in local currency.
Okay. But bottom line, adjusted EBITDA.
Still constrained. They're being prudent, still setting aside provisions for potential bad debt, even as collections improve.
Okay, cautious approach.
Yeah. And you also have to be careful comparing Q1 EBITDA to Q4 of last year.
Why is that?
Q4 benefited from some non-recurring year-end type things, retroactive price adjustments, maybe some procurement rebates.
Okay. So Q4 was unusually high.
Potentially. So Q1 EBITDA showed a decline from Q4, but it's probably a more normalized baseline, although still impacted by those provisions.
Got it. So summing up the geographies, Peru strong, Mexico hit a snag, implementing the model but recovering. Colombia stabilizing cash flow cautiously.
Yeah.
How did this all flow through to the consolidated financials? Let's talk adjusted net income.
Right. Adjusted net income. Interestingly, it actually increased year over year, up by 33 million sols.
Wait, really? With slower growth in Mexico's issues?
Yeah, it seems a bit counterintuitive at first glance. The key is operating profit versus net income. Operating profit actually decreased by 43 million sols.
Okay, that makes more sense. Why did operating profit fall?
Mainly two things. One was FX impact. The Mexican and Colombian pesos weakened against the Peruvian sol.
Right.
And the other was a significant non-recurring item. 23.7 million sols in upfront payments they made to doctors joining from Opcionia, that oncology platform they acquired.
Those integration costs. Okay, so operating profit down. How did net income go up then?
It was more than offset by a big drop in interest expense.
Interest expense? Why was that lower? Related to that refinancing they did?
Exactly. In Q1 of last year, 2024, they had transaction costs booked related to a refinancing they completed in 2023.
Gotcha.
Those costs weren't there this year, so interest expense fell by 53 million sols. That's a big swing.
Okay, that explains a lot.
Plus, there was also a positive FX variance on some financial items related to the Peruvian sol strengthening against the US dollar outside their hedges. That helped too.
Okay, so operational headwinds hit operating profit, but lower financing costs and some helpful FX boosted the bottom line, the net income. What about cash flow generation?
They generated 165 million sols of pre-tax operating cash flow.
Which sounds decent, but you mentioned Colombia collections.
Right. That operating cash flow was definitely impacted by the slower collections in Colombia, particularly in January and February. It picked up a bit in March, but it dragged down the quarterly number.
Okay. And capital expenditures. CapEx.
Pretty controlled. Came in at 4.5% of revenues, about 47 million sols total.
Mostly maintenance.
Mostly maintenance, yeah. Plus about 2 million sols specifically for payments related to those Opcionia doctors coming on board.
And they also had some payments tied to old acquisitions, right? Earnouts and holdbacks?
They did. Used about 17 million sols for that in Q1. The good news is the holdback payments are finishing up now in Q2.
Okay.
And the remaining earnout balance is pretty small, only about 12.7 million sols left.
So putting that all together, what's the actual free cash flow?
Free cash flow for the quarter was 42 million sols.
Right.
If you look at organic free cash flow, which adds back those acquisition-related payments, it was a bit healthier at 59 million sols.
Got it. And interest payments?
Those totaled 76 million sols during the quarter.
Okay. So after all that, How's the overall debt situation? Leverage stayed flat, you said.
Debt structure looks healthy, leverage unchanged quarter over quarter, and they reiterated their commitment to that medium-term target, getting net debt down to 3 times EBITDA or less.
And they did another financing move just after the quarter ended, didn't they? In May.
Yes, important move.
All right.
They successfully refinanced $62.1 million of short-term debt by reopening their existing 2029 senior secured notes, basically issuing more of the same bond.
Okay. How is the pricing?
Got it done at an 8% yield.
Yeah.
Management noted the credit markets were challenging, so getting it done at that level, and apparently the deal was well oversubscribed.
Which is a good sign.
Yeah, suggests decent market confidence. And it pushes out those debt maturities, gives them more breathing room.
Seems smart, gives them flexibility while they sort out Mexico. What other strategic things did they emphasize?
Well, number one priority is clearly getting those doctors in Mexico back on track and recovering patient volumes.
Right. Fixing that friction point.
Exactly. Finding that balance between the doctor's economics and implementing the Auna Way efficiencies.
And the Opcionia deal ties into Mexico too, right? Building oncology there.
Yes. They're using Opcionia as the platform to expand their cancer care capabilities in Mexico.
And those upfront payments we talked about.
Right. The roughly 27 million sols that hit operating profit in Q1. Management flagged those as non-recurring business development expenses, basically an investment to bring those Opcionia docs into the Auna system.
Okay. Anything else on the strategic front? New initiatives?
They sounded quite positive about something called Salud Mexico.
What's that?
They described it as the country's first monorisk health insurance product, initially focused just on oncology.
Interesting. Like a specialized insurance plan.
Seems like it. And they're working on building out the provider network for it beyond their home base in Monterrey, looking at Mexico City, Guadalajara, Tijuana. They said there's pipeline demand driving that expansion.
Okay, one to watch. Did CapEx guidance change for the full year?
Nope. Still guiding to at or below $50 million annually.
Okay.
They also gave a bit of color on taxes, expecting an effective tax rate around 38% this year.
Which is up from last year.
Yeah, up from about 33% last year, partly due to some intercompany payment structure, but they do expect deferred tax assets to help the actual cash tax rate in the coming years.
Got it. And they talked about how long this Auna Way implementation takes, comparing the countries.
They did. They noted it took various years in Peru to really get it humming.
Okay.
It was a little quicker in Colombia. And they expect it to be quicker still in Mexico, partly because they've learned lessons and have more scale now.
But it's not instant.
No, definitely not. They stress it's managed gradually, practice by practice. It's not flipping a switch overnight.
Okay. So pulling it all together for an investor perspective, management owned the Q1 miss, especially in Mexico, but they still sound pretty confident.
That was definitely the tone. Confident about recovering momentum in Mexico as the year goes on, and still very excited about the longer-term potential. They were clear. The core strategy hasn't changed.
But they didn't give full-year consolidated EBITDA guidance, did they? Which they usually do.
Correct. That was notable. They basically said, look, with the uncertainties we had in Colombia earlier, and now needing to see how this Mexico recovery actually plays out quarter by quarter.
But you need more visibility.
Exactly. Need to get a better handle on the Mexico trajectory before guiding the full-year consolidate number.
But they did mention their internal goal.
Yes, they reiterated that internal target of aiming for 20% plus EBITDA growth annually, and pointed out they have a track record over a decade of hitting that kind of growth.
But the narrative seems to be Peru proves the model works. Mexico shows implementing that disruptive model has real hurdles, like these physician issues.
That sums it up well. And getting Mexico right, given its size, is clearly the key to unlocking the broader regional potential they keep talking about.
Okay, let's shift gears. Time for our not financial advice segment.
The disclaimer part.
Absolutely. This is purely an illustrative thought experiment, an outrageous but plausible idea based only on what we heard in this specific earnings call.
Cannot stress this enough. This is not investment advice. Just thinking out loud.
Okay. So management sounds very confident that the Mexico volume recovery isn't just hoped for, it's starting now and should pick up steam through the year. They seem convinced the Q1 issue was a specific temporary bump.
Right. So if you take that confidence at face value.
An outrageous but plausible idea could be selling a put option on an S-stock. Maybe with an expiry out in Q3 or Q4.
Okay, explain the thinking there. Selling a put means you're bullish, or at least neutral to bullish.
Exactly. The thesis would be, the market is maybe overreacting to the Q1 Mexico weakness and this physician friction story. By selling a put, you're betting that management is right, that this threshold event is being crossed, their phased approach works, volumes do snap back in Q2 and Q3 faster than maybe skeptics expect.
And therefore, the stock price stays above the strike price you sold the put at.
Right. If the stock stays above your strike by expiry, the option expires worthless, and you just keep the premium you collected up front for selling it.
So you basically get paid for betting on the Mexico turnaround happening reasonably quickly.
That's the idea. Now, the risk, of course,
is that you're wrong. Management is too optimistic, the recovery stalls, or something else happens, and the stock does fall below your strike price.
Right. If that happens, you could be assigned the shares, meaning you have to buy them at the strike price.
Which might be okay if it's a price you are comfortable owning the stock at long-term anyway, given the strength in Peru and the stabilization in Colombia, but it's still a risk.
Absolutely. So again, just an illustrative idea, pure speculation, based on interpreting management's commentary from one earnings call.
Please, talk to a qualified financial advisor before making any real-world decisions.
Okay, let's wrap up this deep dive then. Auna's Q1 2025. Definitely a mixed bag.
Yeah, you had that clear strength and efficiency shining through in Peru.
Then you had Colombia, where the stabilization efforts on cash flows seem to be bearing fruit, even if they're still cautious.
But then the big story was Mexico. A clear operational setback directly linked to implementing their core Auna Way strategy, especially around those physician-supplier relationships.
Management didn't shy away from the disappointment there, but they projected confidence in their fix and the long-term plan.
They see Mexico as a temporary hurdle, not a change in direction, believing in the disruptive power of their model for the region.
So we've dug into the numbers, the challenges country by country, the financials like debt and cash flow, and the strategic path forward they laid out.
Hopefully that gives you a clearer picture. As you think about all this, maybe here's a final question to chew on. How fast can a model like the Auna Way, which aims to be disruptive, actually change really ingrained economic habits in a healthcare system? Like those physician-supplier links in Mexico, what's the real timeline for crossing that threshold event and seeing consistent gains? Something to mull over.